If I handed you $200,000 right now, there's a good chance you'd never become rich from it. Not because it isn't enough, but because of how your brain is wired. Most people think wealth is about opportunity. It's not. It's about behavior under time and uncertainty. And $200,000 is the perfect psychological test. It's big enough to feel life-changing, but small enough to disappear quietly through reasonable decisions. New car, better apartment, a safe investment, maybe helping family. 5 years later, it's gone, and nothing fundamentally changed. But under the right system, that same $200,000 can realistically turn into millions over time, without lottery luck, without viral startups, without gambling on the next big thing. The difference isn't intelligence, it isn't connections, it's understanding how compounding works, financially and psychologically. My name is Aiden, and today we're going to break down what really happens when $200,000 meets time, and why the outcome depends more on your mindset than the money itself. The $200,000 illusion. $200,000 feels like freedom. In the US, that's more than many people have saved in their entire lifetime. It's a down payment on a house in many states. It's multiple years of living expenses for some. It's, I can finally breathe money. And that feeling, relief, is exactly where most people lose. Because relief makes you want to upgrade your life immediately. This is called lifestyle expansion bias. When income or assets increase, your baseline for normal rises almost instantly. What felt luxurious becomes standard. What felt expensive becomes justified. You don't feel richer. You just feel reset. If you spend $80,000 on a new car and invest the rest casually, you didn't just buy a car. You erased decades of potential compounding. Let's zoom out. Historically, the U.S. stock market, through vehicles like the S&P 500, has returned around 7 to 10% annually over long periods, adjusted for inflation. Now here's where it gets uncomfortable. At 8% annual growth, $200,000 becomes about $432,000 in 10 years, about $932,000 in 20 years, around $2 million in 30 years. And that's without adding another dollar. But here's the part no one talks about. Most of that growth happens in the final third of the timeline. The first 10 years feel slow. The second 10 feel respectable. The last 10 feel explosive. Compounding is backloaded. It rewards patience violently. And human beings are terrible at patience. Psychologists call this present bias. Our tendency to overvalue immediate rewards and undervalue future ones. A nicer car today feels more real than an extra $1.2 million 25 years from now. Your brain discounts the future version of you. So the real question isn't, can $200,000 turn into millions? It absolutely can. The real question is, can you tolerate the boredom, the delayed gratification, and the invisible progress required to let it? Because turning $200,000 into millions is less about math and more about resisting yourself.
The first million is psychological, not financial. Here's something most people don't realize. Turning $200,000 into $400,000 is harder than turning $1 million into $2 million. Not mathematically, psychologically. When you start with $200K and invest it, the early years feel painfully slow. An 8% return gives you $16,000 in year one. That's solid, but it doesn't feel life-altering. You check your account. It moves. Then the market dips. Then it recovers. Emotionally, it feels like nothing is happening. This is where most people sabotage the process. They chase higher returns. They start trading. They jump between turns. They panic during downturns. And this is exactly what happened during moments like the 2008 crash and the 2020 pandemic crash. Many investors sold near the bottom, locking in losses, while those who stayed invested in broad markets like the S&P 500 eventually saw new all-time highs. The market punishes emotional decision-making. And here's the deeper layer. Money amplifies your personality. If you're impulsive with $20,000, you'll be impulsive with $200,000. If you're disciplined with $5,000, you're likely to be disciplined with $200,000. The number doesn't change you, it reveals you. Now let's look at something subtle. At 8% growth, once your portfolio hits $1 million, it generates roughly $80,000 per year in returns, on average, without you adding anything. That's when it starts to feel real. That's when momentum becomes visible. That's when people say, wow, money makes money. But they ignore the 15 to 20 years of quiet consistency that got it there. There's a concept in physics called escape velocity, the speed needed to break free from gravitational pull. Financially, the first million is escape velocity. Before that, you're pushing the boulder uphill. After that, gravity starts helping you. The key insight? The system matters more than the starting amount. If you simply invest the $200,000 into low-cost index funds, automate reinvestment, ignore the noise, and keep your lifestyle stable, you've created something powerful, a self-growing asset. Not flashy, not exciting, but compounding doesn't need excitement. It needs time. And here's where the game changes. Because $200,000 doesn't just buy returns, it buys optionality.
$200,000 buys you optionality. Here's where most people think too small. They ask, how can I turn $200K into $1 million? But that's the wrong question. The better question is, what kind of decisions does $200,000 allow me to make? Because money isn't just a multiplier of returns, it's a multiplier of options. And options are asymmetric. For example, with $200K invested conservatively, you might earn 7 to 8% annually over decades. That's powerful, but slow. But with $200K as a strategic reserve, you can take a calculated risk on a business, buy equity in a growing company, invest in real estate, or give yourself a 2 to 3 year runway to build something without panic. Think about that. Most people don't fail because their ideas are bad. They fail because they run out of time. Cash buys time, and time multiplies skill. Let's say someone uses $50K to launch a small online business while keeping $150K invested in diversified assets like index funds tracking the S&P 500. Worst case, the business fails. The portfolio keeps compounding. Best case, the business scales. Now the returns aren't 8%, they're 30%, 50%, 100% annually on invested capital. This is called asymmetric upside. Your downside is capped, your upside is open-ended. And psychologically, this is powerful, because one of the biggest reasons people never take smart risks is survival fear. Rent, bills, obligations. When you have a financial buffer, your nervous system changes. You think longer term. You negotiate better. You walk away from bad deals. That confidence compounds too. But here's the warning. Optionality only works if you protect the core. If you gamble the entire $200K on a single idea, that's not strategy. That's ego disguised as ambition. The intelligent approach: protect the base, use a portion for intelligent risk, let time handle the rest. And this is where wealth quietly accelerates, because once you combine compounding capital, skill growth, selective risk, and patience, you're no longer relying on returns alone. You're building leverage. And leverage, used carefully, is what separates comfortable from wealthy. But there's one final piece most people ignore. It has nothing to do with investing and everything to do with identity.
The identity shift that turns thousands into millions. Here's the part nobody puts in spreadsheets. If you suddenly had $200,000 in your account, who would you become? Because wealth compounds in the direction of identity. If you see yourself as someone who got lucky, you'll eventually normalize the money and drift back to your old baseline. If you see yourself as someone who is building capital intentionally, every decision changes. This is called identity-based behavior in psychology. We don't act according to goals, we act according to who we believe we are. If your identity is, "I'm bad with money, I deserve to enjoy this now, I'll figure it out later," then 200K shrinks. But if your identity becomes, "I am a capital allocator, I deploy money strategically, I think in decades," then 200K expands. And here's what's fascinating. The math to turn 200K into millions is boring. Diversified index funds, reinvest dividends, let compounding work. Maybe add selective asymmetric bets. That's it. No secret formula, no insider trick. Historically, broad market investing through vehicles tracking indexes like the S&P 500 has rewarded long-term patience. Not perfectly, not smoothly, but persistently. The real difficulty isn't complexity, it's restraint. Because wealth building is emotionally anticlimactic. You won't feel rich in year 3. You won't feel rich in year 7. You might not even feel rich at year 15. But somewhere between year 20 and 30, you look up and the numbers no longer require effort from you. That's when compounding flips. That's when the asset works harder than you do. And that's when you realize something uncomfortable. It was never about the $200,000. It was about whether you could delay gratification long enough to let it breathe. Most people never give their money enough time, and time is the only thing that turns thousands into millions without drama. So if you ever find yourself with 200K, from saving, investing, inheritance, or opportunity, the question isn't, "How can I get rich fast?" It's, "Who do I need to become so this grows quietly in the background?" Because the market will do its job. The real challenge is doing yours. If this made you rethink how you see money and time, consider subscribing for more deep dives like this. And if you know someone who's sitting on capital but not sure what to do with it, share this with them. Sometimes the most powerful move isn't making more money, it's letting the money you already have compound into something bigger than you imagined.